Listen to me. I want you to stop what you are doing right now and pay very close attention, because if you are between the ages of 65 and 70, or you are getting ready to retire in the next few years, you are sitting on the single greatest financial opportunity of your entire life, and most of you are completely blowing it. You have worked 30, 40, maybe 45 years saving your hard-earned money. You put it away in your pre-tax 401(k)s and your traditional IRAs, feeling so proud of yourselves because you got that nice little tax deduction along the way. But here is the brutal truth that nobody tells you until it is too late: Uncle Sam is your secret joint account holder. That money in your pre-tax IRA is not all yours. A giant chunk of it belongs to the government. And if you just sit there and do nothing between age 65 and age 70, thinking, "Oh Susie, I'm retired now, my taxes are fine," you are walking straight into a massive tax trap. Let's talk about the fear that keeps so many retirees up at night. You are scared of running out of money. You are scared of what happens when you turn 73 or 75 and the IRS forces you to start taking required minimum distributions, those dreaded RMDs. Suddenly, the IRS tells you how much money you must pull out of your traditional IRA whether you need it or not. And guess what happens when those forced withdrawals pile on top of your Social Security benefits? Your taxable income skyrockets. It pushes you into higher tax brackets, it causes up to 85% of your Social Security benefits to become taxable, and it triggers giant Medicare premium surcharges. That is the tax torpedo, my friends, and it will decimate your retirement paycheck if you do not take control right now. Why are the years between 65 and 70 called the gap years? Because this is the magic window. For many of you, your W-2 work income has stopped, but your required minimum distributions have not started yet. You might also be delaying your Social Security until age 70 to maximize your monthly payout, which is a brilliant move if you can afford it. That means for these 5 short years, your taxable income drops to historic lows. You are sitting in a low tax bracket, and that lower income is pure gold if you know how to use it. So what is the question you need to ask yourself right today? The question is, why am I waiting to pay taxes at unpredictable, potentially higher rates in the future when I can pay taxes at known, historically low rates right now? This is where the power of strategic Roth conversions comes in. During these gap years, you deliberately pull money out of your traditional pre-tax IRA and convert it into a Roth IRA. Yes, you will owe income taxes on the amount you convert in the year you do it. But listen to me very carefully, once that money is inside a Roth IRA, it grows 100% tax-free for the rest of your life, withdrawals are 100% tax-free, and under current law, Roth IRAs have 0 required minimum distributions for you. You are taking control away from the IRS and putting it back in your own hands. Instead of converting everything all at once, you use a strategy called bracket topping. You look at your taxable income and fill up the lower federal tax brackets, like the 12% or 22% brackets, right up to the top, but not a single dollar over. You do this year after year from 65 to 70. By systematically shrinking your traditional IRA balance during these gap years, you drastically reduce your future RMDs. That means when age 73 hits, your forced withdrawals will be a tiny fraction of what they would have been, keeping your future taxes low forever. Now, I have to give you a massive warning, because if you get greedy or careless, this plan will backfire on you. You must watch out for the Medicare IRMAA trap. IRMAA stands for Income-Related Monthly Adjustment Amount. When you turn 65 and go on Medicare, your Part B and Part D premiums are based on your income from 2 years prior. That is a 2-year look back. If your Roth conversion pushes your modified adjusted gross income even $1 over Medicare's income thresholds, your Medicare premiums can jump by thousands of dollars a year for both you and your spouse. IRMAA is an absolute cliff. So when you calculate your conversion amount each year, you must keep your total income just under those Medicare threshold lines. Do not jump over the cliff. And here is another rule you must promise me you will follow. How are you going to pay the taxes on that Roth conversion? Do not withhold taxes from the IRA distribution itself if you can avoid it. You pay the taxes using liquid cash sitting in your taxable bank or brokerage accounts. That way, 100% of your IRA dollars get moved into the Roth where they can compound tax-free for decades. If you don't have the cash outside your retirement accounts to pay the tax bill, then you slow down and convert smaller amounts. Can you do that for me? Here is your actionable takeaway starting today. Step 1. Gather your tax returns and look at your current income sources. Step 2. Figure out how much room you have in your current tax bracket before you hit the next bracket or the nearest Medicare IRMAA limit. Step 3. Consult with a qualified CPA or fee-only fiduciary financial advisor to map out a multi-year Roth conversion ladder from now until age 70. Do not let fear keep you paralyzed. Do not let the IRS dictate your retirement security. Take advantage of your gap years while the window is wide open. You worked way too hard for your money to give away more than your fair share to taxes. Protect your wealth, protect your peace of mind, and remember, people first, then money, then things. You can do this.